Hey guys, what's going on? Todd here. Just want to do a quick video, I promise. Just talk about inflation expectations, nominal yields, and real yield curves. That's a lot in hopefully just a couple minutes. Real quick. So this is the 10-year break-even inflation expectation. So this is where inflation is viewed to be by the markets on average over the next 10 years. You can see we're up around almost 3% here in March, Q1 of 22. We're down to 2.2% on the 10-year. 5-year, 2.27. And then if we look at the 10-year real yield, okay, so 10-year real interest rate, 1.79. You can see in the red, we almost got down to, we did get negative. Real yields were negative twice in 12 and 20. And we've rallied here. So you take the nominal 10-year yield, which is 3.645, factor in inflation expectations at 10 years, and your real yield on the 10-year is 1.79. So that's your effective long-term borrowing costs at current inflation rates, okay? Looking here, this is gonna be 2-year inflation expectations. And then below here is 5-year. So you can see we spiked up 3% on the 2-year. We're back down to 2.4. 5-year, we got up to 2.5. We're at 2.3. So we're talking 2, 5, 10-year inflation expectations to be sub 2.5%. All right, this is kind of the main point I think of what I wanted to share with you, and it came from a YouTube comment from the video I posted last night, which is good. And you're saying just watch the significant yield curve inversion, and it's real. I'm gonna call an audible here so I can pull this up quickly. There is a lot of inversion for sure. It doesn't matter if you're looking at the 10-year, 3-month, 10-year, 2-year yield curve. It's real. Let me just pull this up real quick on Y charts. Let's do 10-3. Okay, so 10-3 right now we're minus 1.08%. And if we back it out, go to 5 years, minus 1.08, and then we can go out to the 10-2. Should be pretty quick at the top. If not, I'm going to bail on it, but you're going to get the 0.7 10-2 spread against the S&P. So the 10-2 is down around negative 0.8, but these are nominal yields, not counting inflation, okay? And if you borrow at 4%, but you're being inflated away at 6, 7, 8%, it's a good deal. So I think to look at the yield curve, and this is something I looked kind of high and low to find, so I constructed one on my own, which is a real yield curve. And the best I could find from the Fred database was a 20-year Treasury Inflation Index security and a 5-year inflation indexed security. Now, I'm sure some people are a lot smarter than I could do something that reflects the actual 10-2 yield curve. The best I could do was 20 to 5-year. Okay, so this is inflation indexed 20-year Treasury subtracted from 5-year subtracted from 20. And what you can see here is the S&P overlaid on this synthetic spread. So the low is here in September of 22, and what you'll notice is we are going positive again on this 20 to 5-year real yield spread, okay? It didn't go as positive as we were here in October 22, but we're sneaking back above. You can see we're making a series of obviously higher lows. You can see there's a real correlation, between these two products here. So let me pull the S&P up, get back to credit crisis. I mean, look at that massive drop right there. That's pretty significant real yield curve inversion, 20 to 5, minus 1.2%. Where we are now, not even close. not even close. We got down to like 30 bips on this, okay? So, I'd be curious to get your feedback. What you think? Come on, white charts. Or, sorry, Optima. I can't grab this thing. There we go. So anyways, just watch this. If we could reapproach positive here, combined with the S&P holding that 4,100 mark, I think that would be constructive for the overall market. So we just pull those back on top of each other and you can see where we're going there. All right, guys, quick little video. Hope that helps. Curious to your comments and feedback. Jay Powell speaking today. Things look to be fairly quiet until then. All right, see you guys.